All right. Welcome, everybody. Go ahead, Omar.
Hello, everyone. How's it going, Mile? What's up?
I'm fine. How are you?
Good. Should we get started? I think we have a packed house.
Yeah, let's do it. Sounds good.
All right. All right. So, anyone of you has invested in multifamily syndication in the past 5 years, and your check stopped coming? This webinar is about how it happened, who did it, and what the people who saw it coming did differently. In other words, an entire industry got the sauce, and then they got lost in it.
That's right. That's right. So since January, we've been pulling this cycle apart. Today, we put it back together so you can see exactly where it broke. So let's first chat about the boom that happened from 2012 to 2022. By 2019, there were more syndicators running Facebook ads to doctors than there were qualified operators in the country. The barriers to entry didn't lower, they legitimately vaporized. Platforms built by physicians for physicians, dentists teaching dentists, funds for engineers, funds for pilots, funds for veterans, same deal, different Facebook audience. If you had a W 2 and a pulse, somebody had a fund for you.
And look, the ones who couldn't syndicate or were mediocre at it, well, they found something even more profitable: selling courses. And these people became mentors, gurus, influencers, you name it. I mean, these people made more money selling courses than they ever made in real estate, which they claim to be experts at. And everybody was chasing in on the same phenomena one way or the other. And the pitch was always the same: IRRs at or above 20%, passive income, tax breaks. And the audience was always the same: high income earners that are great at their craft, great at their job, not really real estate.
In 2012, the floodgates really opened. So Congress passed the Jobs Act of 2013 and the SEC adopted Rule 506C. So for the first time, syndicators could advertise directly to investors. No pre existing relationship required. They could run a Facebook ad and that could lead to collecting a check. That was the infrastructure. Then it got the fuel. We all know what happened in March 2020. COVID. Rates dropped literally to zero, and $5 trillion flooded the system.
And look, guys, bridge lenders were handing out capital like it was candy. Rate caps, these are basically insurance against rising interest rates, typically 1 to 3 years. These were really cheap. Really, I mean, I cannot emphasize how cheap they were. To give you some context, we had a transaction in 2021 for that notional amount. I think we paid like 37,000 or something.
Yeah.
And for that same amount, about 2.5 years later, that same exact instrument was going for 880,000, give or take. So that tells you how cheap things were and where things went. And floating rate bridge debt, everybody's swearing they're not going to use it. Well, floating rate bridge debt was the intelligent thing to use at that time because it was significantly cheaper day one. I mean, there was no questions about it.
Right.
And a lot of people sponsors especially, bought these rate caps. They thought they were protected. Not really. And nobody underwrote for rates going up, interest rates going up, because they hadn't gone up since the great financial crisis. In fact, interest rates kind of had been in a secular downtrend since the 1980s. There are entire generations, not generation plural, generations of sponsors where they had never operated in a rising interest rate environment. I mean, there's entire swaths of people have come into the industry and retired, and they were never in an environment of rising interest rates. And look, Isaac Newton, one of the, I believe, smartest people in human history, well, he kind of fell into a similar trap because in 1720, he sold South Sea Company stock, and then the price kept going up. He saw everybody making money. He got in at the peak of the market and lost the equivalent of something like 40 million pounds.
Oh.
And this, one of the smartest guys in human history, is reported to have said, and I'm going to read this: I can calculate the motions of heavenly bodies, but not the madness of people. So, so this is one of the most intelligent people on the planet, well, in human history, frankly. And sponsors who bought apartments, say in 2019, 2020, they sold these apartments pretty quickly. They made money. I mean, we're talking real money. We're talking people that, let's assume, had never made more than 50, 80 grand, and then their life suddenly turning into like $1 million overnight, like that. And they did what every intelligent person in every single cycle always does. They bought back in. So they bought back in, say, 2021, 2022, right at the top of the market with floating rate debt, paying 30 to 40% more than replacement cost in some cases. And to give you some context on how crazy these things were, because we lived through it, in select markets in the Sun Belt, 80s vintage product was selling for something around 3.5% cap rate. Now, cap rate is very different than rate cap. If you don't know it, email us. We're more than happy to tell you. But 80s vintage product was selling for something like 3.5% cap rate. And this isn't like some mom and pop buying it. This isn't like a guy who just took a course buying it. This is everybody. That's the market price. Very many institutional, so called sophisticated investors bought this. Think about it, a 3.5% cap rate property for something that was developed in the Reagan administration. I mean, if you tell somebody, if you say Ronald Reagan, people assume these days it's ancient history, right? It's like something back when the dinosaurs were alive or something. It wasn't that long ago because these buildings are still there. And to give you some context, I've got these numbers here. In 2021, there was a record 335.3 billion with a B, in multifamily transactions. This was double the average of the 2015 to 2019 transaction volume of $168 billion. Think about that. So that's how lost in the sauce the market was. The problem wasn't, the problem wasn't the sauce. The problem was everybody assuming the sauce would last forever.
Omar, you were operating through all of this, so this gets a little personal. What was that like on your end?
Yeah, it does. I mean, I lived through this. So, I mean, look, this happened to us directly. Investors were blindly investing into any deal that showed the highest projected return, no matter what you told them, no matter, hey, this may or may not check out. It's like a 50s vintage deal in a bad part of Atlanta. Things don't make sense, right? Your rents can't be the same as Class A rents. Nobody bought, nobody listened to us. Time and died again. I mean, look, we had a choice. We could underwrite to fit to this little box, but we purposefully chose to not do it. In fact, we declined. We purposefully chose not to do deals. We purposefully did not raise as much capital as we could have, even though we had a lot of pressure from investors to accept capital and go deploy it. And the sponsors keep selling this dream. You have to understand, when you're in a cycle, sponsors will keep selling you this dream. And investors kept buying this dream. And both sides are paying for it now, as we've seen in all these headlines. And then in March, I think it's March 2022, the Fed did something it hadn't done since the great financial crisis.
Yeah. So what happened in March 22? Well, the Fed started raising, and 525 basis points exactly in 16 months, which was the fastest since the early 80s. So again, clearly there were generations that had missed a Fed raise or a rate raise of this magnitude. The party didn't wind down. Somebody flipped on the overhead lights, killed the music, and asked everyone to settle their tab. The rate cap costs exploded from 5x to 30x increases. A 50K insurance policy became a 500K to $1.5 million bill overnight. And with no in-place rate caps, that meant there was a full exposure on every dollar of debt to the raising interest rates. When those caps expired and the real rates hit, the cash flow investors were told was sustainable, it vanished. Bridge loans at 3.5% reset to 8 to 10%. On a $30 million loan, it became a $1 million annual debt service. That became, $2.5 to $3 million. The same property, same tenants. Really, the loan was what changed. Properties didn't break, tenants didn't leave, loans didn't break. What happened was the capital stack failed, not the real estate.
And just to put this in context, to provide some relief for themselves, Many sponsors started raising what they euphemistically termed as income funds, pref equity funds. And just to be totally clear, there's nothing wrong with income funds or pref equity funds in isolation. They've been used for a long time for the right cause. In this case, these were just sponsors trying to bail themselves out at the expense of their investors. And most of the income funds raised at this time were effectively capital calls. Sponsors just didn't want to call them a capital call. This is literally what happened. In fact, it's happening right now in certain cases, but it really took a fever pitch in the last few years. And what these income funds did was sponsors charge typically fees on this. So they're charging you fees for the privilege of bailing themselves out, number one. They funded loan extensions, but the problem with an extension is that it doesn't solve your underlying problem. Your underlying problem is your cost of capital is very high, and you don't solve the cost of capital problem by layering on even higher cost of capital. So really what the income fund did is it basically gets you an extension. Extension doesn't solve your problem because it doesn't reduce your rate and doesn't delever the property, right? There's two ways of reducing your debt service payment or your mortgage payment. It just gives the lender more of your money, as an example, if you're the investor. It buys you some time, but again, that time isn't like a lot of time because typically you'll get a 1 year extension. But at the 6 months mark, your lender rightfully will say, all right, dude, like, what's your plan? Because it's even in an orderly market, a great market, a booming market, it takes 3 to 4 months to sell a property. So obviously at the 6 months mark, you got a 1 year extension. You don't really got 1 year. What you really got is 6 months. And the lender is then breathing down your neck again. So you're kind of left right back where you started. And this time you have even less money, basically, than before.
Yeah. So just let's recap that for a minute. So the first loss was the equity in the original deal. The second loss was the new money investors put in trying to save the deal. And it doesn't take someone with a PhD to understand the consequences of that. Multifamily property values went down 20 to 50% from peak, depending on the market and the asset. Texas, where Omar is located, was hit very hard. There
Yeah,
was
thanks for
distress.
bringing me into the conversation. Thank you. Thanks for
That's right.
including me.
Georgia was also hit hard, for the record.
Okay.
But that's not how I wrote this, okay? Texas was hit
Mhm.
hard. There was distress
Okay.
multifamily heading into auction across Dallas, Houston, San Antonio, and Austin. We chatted about this last month. There is right now $400 million on the chopping block, and the number inches up every month. Those are astronomical numbers. And the mechanics are simple. Floating rates reset. NOI can't cover interest. Sponsors contribute equity, but it runs out, and the keys go back to the lender, and investor capital goes to zero. A lot of you have stopped getting checks from another sponsor sometime in the last 2 years. I've spoken to many of you. Some of you have gotten asked to put more money in, so you know exactly what Omar's describing because you lived it. So, Omar, again, another question directed to you. You're not above any of this. How did it hit Boardwalk?
So, look, some of you watching this have invested in one or more of these deals with other sponsors or whatever. So, you know exactly the situation Miles and I have described because you've lived it. You know exactly the situation. And full disclosure, we were affected as well. We had assets where distributions needed to pause, and we proactively paused them because we want to be the best stewards of capital. Some of these situations are still in progress, although we've checked off most of these progresses. Now, this is the reality of anybody that was acquiring or developing in the previous cycle. That's just the way things are. Anybody that tells you they're not affected is lying to you. Either that or they're a magician, one or the other, right? So, to give you some context and show you how we're basically checking off these problems, on Pines of Lanier, as an example, we paused distributions to preserve capital. We focused on operations even more. We executed a cash out agency refinance. This was one of the only two cash out refinances in the entire bridge lending book from 2022. We got a multi-million dollar cash out refinance. We restarted distributions and we're pretty much all caught up. Now, the reason why I point this out is because situations like these require operational excellence, legal sophistication, this is very important, and capital markets depth all working together. Most groups have one, some have two, but hardly any groups in the lower to middle market space have all three going for them at the same time. So having all three is what makes pivots like these possible. But you don't solve, I just want to point this out, you don't solve a cost of capital problem by layering on more expensive cost of capital. We'll go down into detail how we lowered our cost of capital through these refinances.
Mhm. Yeah, no, that's worth sitting with for a minute, for sure.
You have to understand, guys, the capital that's left these deals in the industry, it hasn't evaporated. This capital merely has transferred. Because what's happening now is every asset a sponsor has handed back to the lender, somebody like us has acquired it at a 20 to 50% discount below what the previous owner paid for it, right? So the question isn't whether, look, wealth was destroyed in this cycle. It was destroyed, but the question is, where did this wealth go and who has it gone to?
Yeah. Yeah. And if you know someone honestly living through what Omar just described, send them this replay. The next 10 minutes, we're going to get into exactly what we've learned and what we did about it.
And look, did everybody get lost? No. So I just want to now point this out, like what was the market scenario in this time? We were in the same market as everyone else. Same brokers, same intermediaries like other owners, sellers, lenders, similar deal flow. We bought assets in that time period. We sold assets in that time period. But here's what happened. When we started getting offers for our 70s, 80s, and 90s vintage assets that were above replacement cost. So this means that if you were to go develop an asset from like literally the ground up, like a new asset, we were getting offers on 30, 40, 50-year-old assets that were higher than it would be to go and develop the product from the ground up. I mean, it makes no sense. It's like buying a 40-year-old car, which is not, say, a Ferrari or something like that. It's like, I don't know, buying a 40-year-old Camry for more expensive than a new Camry. It makes no sense at all. So what we did is we started selling all of these assets. I mean, in fact, we had 6 dispositions between 2021 and 2024, 26.6% IRR, 2x equity multiple. And I just want to point out these are home runs, but these are only home runs after the fact because these are not the numbers we guided our investors to.
Yeah.
This is just to give you a context. This is not to give ourselves a pat on the back. I'm openly saying this is how distorted the market was, that the returns were crazy in 2 or 3 years' time. This is not how a normal functioning market should work, especially in real estate. So we are always aiming for singles and doubles. Those are the types of numbers we are guiding our investors to. We don't guide our investors to 26.6% IRR and 2x equity multiple. So what we did is when we were getting all these offers and selling gladly at above replacement cost, we took our money, we pivoted to the upper Midwest. So we've done over $250 million of value of developments over there, typically with fixed 5-year construction debt. And as a result, we avoided a lot of carnage, not completely avoided, but did avoid a significant portion of the carnage by actually going into stabler and safer markets that were out of style or out of trend at that market. And now, as we're delivering all of these developments, we've effectively started the process of refinancing into fixed rate agency debt. In fact, we recently refinanced Maple Rock Reserve. We did a multi-million dollar cash out refinance, and we have more in the pipeline. So to give you some context, look, every market I feel has challenges. It has opportunities, it has challenges. And the thing is, in my view, every market has a different type of playbook because what works in a hot market doesn't work in a down market. And what works in a down market doesn't typically work in a hot. So, in our view, for this leg of the cycle, fixed rate, long term agency financing is the answer because it is the cheapest cost of capital. But the conundrum for a lot of operators that you hear on social media or you read about is that these people do not qualify for this type of financing. Either they're not operationally good, they're not a preferred borrower, their assets do not qualify, or they themselves do not qualify. So they are stuck at high cost of capital options. And pretty much everybody from a Blackstone down to our level, whoever can execute, and we've done over like, I think a dozen of these now, or like at least close to a dozen of these financings, Whoever can do this agency financing does this agency financing because it is the cheapest, by far the cheapest game in town. Now, another example of this is because of the strength of our platform and our reputation, a New York based institutional investor reached out to us 2 years ago. We helped them source, secure, and then execute on 11 distressed deals, I believe 1,500 units, all across the Sun Belt, 5 states. These were at anywhere from 20 to 50% off discount of peak pricing. And we stabilized the assets. We gave it to the New York based institutional partner and we got our share out of that. So, the reason why I mention all of these things is that we are able to do this because we are not burdened now with legacy assets and can play offense when others are playing defense. But to do this, many years ago, we had to take a decision to go into to do things that were not, say, popular at that time, and to go into markets that we felt offered compelling value, but others wanted to go into, sexier, cooler, nicer markets. And here's what I want you to understand: most sponsors are negotiating with lenders right now. We have and are engaged in multiple fixed rate agency refinances where we take out multi-million dollars in a tax efficient manner. Just think about that. Like I discussed Maple Rock Reserve a short while ago, right? There we sourced a 7-year fixed rate agency refinance, 7 years interest only, 35-year amortization, and I believe we saved about 295 bips, which means 2.95% off our interest rate, just the pure rate. So that's now translating into close to $400,000 plus just in debt service costs alone. Forget about any upside from rents and all of that sort of stuff, right? With a multi-million dollar cash out, that is now returning capital to investors. On Lofts at Eden, we recently did a refinance, same playbook. We had a 7-year term, 5 years IO, and our interest rate went down, believe, between 250 to 330 basis points. So that's just pure savings going right down to the bottom line. We also have additional agency refinances in the pipeline. Look, the point I'm trying to make is a lot of decisions we are making right now are the result of decisions we took earlier. So you have to keep this in mind that when things are really good, you gotta take your chips off the table, not add more to the table in the hopes that you're gonna double down. So if you're watching this and thinking, how do you position yourself for the next leg of the cycle? That's a conversation worth having. We're putting our own funds, and we're putting our own capital into a fund we're launching to capitalize on this. So if there's any interest, please talk to Miles.
Mhm. Yeah, perfect, Omar. Thanks. No, that was a good summary of how we've pivoted and what's happening since this great divide. Why don't you bring us home in terms of closing this out? What this all means now?
Look, I want to emphasize here, though, that there are many well meaning, thoughtful professionals in our industry, but merely being good at your job, it doesn't cut it anymore. It takes a macro level view. You have to have the ability to go into the weeds and take a 50,000 foot view to put the pieces together in real time because the market conditions are very volatile right now. And the people who got lost in the sauce, the people who got lost in this whole little thing, they are handing their assets at steep discounts. And the people that kept their heads and took painful decisions earlier, they are now reaping the advantage and have the ability to capitalize and acquire these assets. So while it might feel like this is a downturn in the industry, every cycle has shown us that real long lasting wealth is not made during boom times. Real long lasting wealth is made investing during down times because that's when you're really getting assets for cents on the dollar. But it's very mentally painful to invest during a downtime. So, that's why only a few people get to the other side and not everyone.
Yeah. Yeah, this environment doesn't reward speed, does it? It rewards the people who can sit still, longer holds, assets that need work, returns that show up in years, not quarters. And again, if that's how you think about money, you know where to find Omar and I. Omar at boardwalkwealth.com, Miles at boardwalkwealth.com. So that's the end of this webinar today. Thank you all for joining. What we want to do now is what we've done on all our previous webinars is take questions from all those who are participating. So you can use Zoom to plug in your questions. We already have a few coming in, but yeah, please keep them coming, and we'll try to make enough time to answer them. So Omar, why don't we start with the
Yeah.
first one I noticed come in? So what should I do if I'm in a deal where the checks stop?
Well, first of all, I'm sorry to hear that. Look, there's a couple of questions I think you can ask your sponsor as an example. Again, this is not an exhaustive list. Number one, like what type of debt structure do they have right now, and what's their game plan going forward? So if they have floating rate debt right now, where are they going? If they have fixed rate debt right now, they're in trouble. Okay, well, what's happening right now? So, what type of financing do they have? Where are they going? Because both points are important, where you are and where you're going. I would think about, look, debt related metrics, like what's your current DSCR? This is basically, the ratio to income to loan payments, right? And or what's your debt yield at? Or what are the refinancing mechanisms that a sponsor is considering or thinking about right now? And look, if they can't or won't tell you this answer, that kind of gives you an answer in and of itself. If they obfuscate and don't give you a clear answer, because none of this is rocket science, guys. We're in real estate. Okay. Frankly, if I was that intelligent, I'd try to be a doctor or something, but not. I'm in real estate. You have pretty clear answers over here. The other thing that I'd like, a couple of other points I'd like to see is, hey, is the sponsor contributing their own capital? Because if not, look, the incentives are sort of misaligned, right? I don't know if that helps you or not. And lastly, you also have to understand, if there, be prepared that if there is a loss, God forbid, just be prepared that sometimes it's better to take a small loss today, move on with your life, than to try to get greedy and then take a bigger loss. Right. So just got to keep that in mind. None of these are, extremely exciting answers that are going to solve your problem, but at least they provide you context. So then you can make a more informed decision.
Yeah, Omar, why don't we take that question a little bit further? So, how about those who find themselves in deals where the sponsor has um, made requests for a capital call? What should investors be evaluating in terms of if that's the right thing for them to do to add more capital to a deal?
Well, look, first of all, you have to understand capital calls by its nature, there is nothing wrong inherently with a capital call. Same as there is nothing inherently wrong with an income fund or a pref equity fund or any of these things. All of these things exist to address a problem that has happened in the past, right? But you can't just stop there, because somebody saying, hey, give me more of your money, but they don't give you a plan going forward, doesn't kind of make sense to me. I said, look, I'm a sponsor, I'm an operator. I should be telling you, give me all of your money as an example, right? But I can tell you that good, thoughtful sponsors are not going to approach their investors and say, yeah, look, I kind of messed up earlier. Give me more of your money and maybe I'll figure this out. By the time they get to you, they should have a clearly laid out game plan. What type of debt same kind of similar to what we discussed earlier. What type of debt do we have right now? What type of debt are we aiming for? Where are our actual P&L numbers right now? Where do we realistically expect them to go? Why do we realistically expect them to go? Because look, you guys have to understand, this is similar to what happened in the last leg of the cycle, where I was telling you, investors were just investing in the highest possible deal. Sponsors, when they need your money, are incentivized. This is human nature. I'm not trying to call out somebody, right? This is human nature, that they are going to be more optimistic than reality 90% of the times, because they want your money. This is like going to a barber and asking if you need a haircut. No offense, Miles, right? If you need a haircut, what is the barber going to tell you? The barber is, of course, going to tell you you need a haircut, right? So, why is as important as where you are going. Stress test the assumptions. See what clearly if a sponsor is giving you an answer or not, because frankly, there's only a couple of variables here, guys. This is not rocket science. We're not trying to do surgery here where, I don't know, there's like a billion complexities here. Is the work hard? Yes, it's very, very hard in a volatile environment. But if a sponsor is reaching out to you for a capital call, they should provide you a clear plan on what that money is going to do, why that money is going to do that thing, and what do you get in exchange. It is not good for you to throw good money after bad, but realize capital calls by definition are not evil. Sometimes you need to spend more money, but you better be sure You're not throwing good money after bad.
And is it fair to reduce it down to because we've spoken a lot about the debt structure and the capital stack. If there's no attendance to fixing that debt structure as part of this capital call, is that a fair reduction or will there be outliers still? I feel like you go ahead.
I can't fathom a situation right now. And I say this with a disclaimer that there's always one situation in America, right? But I can't fathom a situation right now where somebody needs money, but they do not have a capital structure problem. The capital structure is a problem for the vast majority of cases.
Right.
So, yeah, I mean, maybe there's this one unique situation that exists somewhere, but I don't think most investors are going to encounter that. Capital structure and the way you lay out your capital stack is pretty much the entire game right now.
Yeah. Yeah. No, that's good. I think that's very helpful to arm everybody watching this in terms of what to look for. Next question in the docket is how did rate caps hide the real risk?
Yeah, that's a very good question. Whoever's asked that, that's a very astute question. Look, so you first have to understand what is a rate cap. A rate cap is an insurance against rising rates. So think about it this way, literally like an insurance. You are paying upfront for the guarantee that if something bad happens, you will be protected against it. So something bad happening in this case is interest rates. You have a floating rate loan and you buy a rate cap that says, hey, if your index rate, the treasury or the SOFR, goes above a certain number, whatever that number is, any amount above that, you will get reimbursed from the rate cap provider. These are typically big financial institutions. These are not mom and pop. So by and large, this is very stable in terms of receiving your money, reimbursement, very stable. So essentially what it says is you are paying upfront for a guarantee that your rate will not exceed a certain level. So some sponsors, don't want to take names, have made this into an art form because they've showed artificially low cap rates on artificially low rates on their performance due to a rate cap, right? They just prepay upfront and reduce their debt servicing costs. It's a bit like if I had to pay $1 million a year from now, I pay my lender $500,000 today, but only show $500,000 on my P&L. So uh, a lot of investors will assume that $500,000 is the actual real interest rate. They will then believe the property is actually generating real cash flow, meaningful cash flow, because the DSCR is good. It's all hunky dory. But this prepayment of this interest rate of this interest is basically masking the true cost of the debt. Right? Does this make sense? Like, if let's assume your debt servicing costs were going to be $1 million, but you say to your lender, "Look, I'm just going to pay you $500,000 up front. So really, $500,000 is only what hits my P&L." Well, yeah, but you're not being completely clear here because you already paid $500,000. You prepaid for it. So when these rate caps expire, right, and these costs went from, I don't know, 10, 15, 30x more, this created carnage because now the real rate started hitting the P&L. And when the real rate started hitting the P&L, all these investors who looked at the P&L were like, oh, it's a really low rate. It's whatever. The DSCR is good. There's real cash flow. Realized there was no, in the words of that famous politician, there was no there. There wasn't real cash flow. And I can tell you this because I'm a sponsor. I see this all the time. Some groups have made this into an art form. They prepay for interest. They artificially show a lower number. They pump up their numbers on paper. And investors don't really read between the lines and don't really understand. And I don't blame the investors here. I'm just saying a lot of groups do this. They were getting away with it for so long. And this is how they used to actually show higher numbers.
Right. So, Omar, in the same spirit of the first question, just arming investors with the intel and the right questions to ask. If you have if you have an investment right now that's potentially looking like it's doing well, is that another pertinent question that an investor can ask their respective sponsor? And that is, what is the rate cap and when does it expire?
Now, this is a totally pertinent question. You're an investor, you're a partner in the transaction. I mean, not just this, any reasonable question is a reasonable question to ask.
Mm-hmm. Yeah,
So,
no, I
yeah,
think it's
It is, yeah. It's under the no shit Sherlock sort of, criteria. Yeah, you better know what this is. And again, I just want to point this out again, guys. There is nothing wrong with rate caps. They are legitimate instruments used to smoothen volatility. But it's like a bit like, you can have a hammer to hammer down a nail or to kill somebody. Like, if you hammer down a nail, that's great. That's an actual use of a hammer. You used it to become a serial killer. Well, not really the best use of a hammer, in my opinion, right?
Right.
Lots of groups have pioneered this into an art form now, and investors are slowly beginning to catch up. And part of this webinar is to educate people and for them to understand what's going on.
In the environment we find ourselves in, which is somewhat of a perfect storm, is there still use for the rate cap right now? Are you hearing of sponsors utilizing rate caps, or are they
Yeah,
just
there are many that are still using rate caps. Again, they're using it. Some of them, again, like I mentioned, are made it into an art form, but some of them legitimately. Let's assume you've got a great asset. For whatever reason, it's performing well, and you are going to exit in 1 year, and you've got a buyer lined up. Sure, get a rate cap. It's no problem. Again, the tool has to match the usage. If you take a tool in your toolkit and then kind of go bananas with it, and you're not, look, point I'm trying to make is there is so much disclosure in these deals. A sponsor can point out and say, look, I had this on page 43 in section B of like my PPM. So I disclosed it. Well, the point is nobody's going to read that. So technically, literally legally speaking, you can't really say the sponsor is misleading you. It's just that they've buried all of these details in various obscure spots. Nobody's going to find out. So that's where bad things happen to good people.
Mhm, mhm. So then, how does an investor vet these deals when there's information buried so deep? What's the best way to be scrutinous?
Well, it's an old saying, you measure twice and cut once. So you shouldn't trust any sponsor. Look, I am a sponsor, guys. Okay. Do not, look, I'm a sponsor. Like, it pains me to say this. Do not trust any sponsor. Get verification. Ask for their investors, ask for their partners, talk to people, have more than one conversation. Do not blindly accept what somebody's telling you. And again, I want to reiterate, I am a sponsor. You guys are going to ask me the same questions. Ask questions. This is your hard earned money. This is a sum of your blood, sweat, and tears. Ask questions. Do not just blindly believe. This is not, this is not a religious experience, right? I mean, this is a business transaction.
Yeah.
You are giving your money as an example to me, and I have to go do the job that you have told me that I have to go do. There is nothing more complex than this. I can assure you of that. So you shouldn't trust a sponsor based on purely what they say. Go off their track record, talk to their other investors, talk to partners, research them online, have multiple conversations. Look, in our particular case, we've done 33 transactions. We've just poured cash out on agency refinances multiple times. You can verify that. It is, I mean, heck, we'll verify this to you by showing you statements. But even in our case, you should talk to our investors. You should talk to our partners. So don't believe what people tell you. Pretty much anybody online that is trying to get your money is either overly optimistic or they're lying to you. Just believe that. That's just the way things are. This is not alarmist. This is not trying to scare you. Look, I'm a sponsor. I'm in the business of raising money. That's just the reality of the situation.
Omar, let's finish with this last question, and then we can let everybody go their merry way because I think it's late in some parts of the country. If the cycle repeats, what stops it?
Nothing stops it, guys. You have to realize cycles are part of human nature. Any single time, any entity, whether it's the government or other organizations, try to tell you that they have found a way to take cyclicality out of the natural rhythm and flow of business, relationships, anything of the sort, it doesn't happen. It always leads to disaster. Cycles are part of human nature, they are part of living experiences. So you have to realize if Newton couldn't calculate the madness of people, and he's one of the smartest human beings that has ever existed, we can't calculate it now. That's just the reality of the situation. But what gets what changes is who gets hurt, as an example, and what steps can you take to reduce the probability of getting hurt. So we feel in this leg of the cycle, fixed rate debt, conservative underwriting, discipline to sell when the math says sell. These are aspects that can reduce the probability of getting hurt if you're an investor. So the question is whether you are positioned to benefit from cycles or to be damaged by cycles. That's the way I look at it. And in this leg of the cycle, again, a lot of these questions are centered around capital stack and capital structure decision making, not like a market prediction of, I feel, I don't know, Atlanta is going to have rents go up by 10% next year. Okay. Nobody can verify and give you that answer, not even people that work in the industry.
Mhm. Good. Well, thank you, Omar, and thank you everybody for joining us. Omar, any final words before we?
Oh, just the same thing as always, guys. Measure twice, cut once. And I'm sure I'm not the only parent that's told this to their children. The same principle applies. If a guy on the street offers you free candy and tells you to go into the van, don't do it. That's the easiest way to get kidnapped. Similarly, online, if you hear somebody telling you, a guy or girl, but usually it's guys, oh, they have this 20% IRR deal and they've got this income fund where everyone's paying 5% and this guy can pay you 20% or 15%. Run away. Magic does not exist. Investing is extremely boring. And like that old saying that if you want excitement, get a dog.
I love it. Thanks everybody for joining us. We appreciate you, and we will stay in touch. Thank you.
Bye for now.
Bye.